What's up guys, Chase here, and today I want to talk to you about selling covered calls. So let's be honest, if you're watching this video, you probably don't know a ton about covered calls, but you're curious. So that gives me a good opportunity to tell you that I am not a financial advisor, and I too don't know everything that there is to know about financing. I've learned quite a few things about selling covered calls, and I'm going to teach you the basics that I know. And we're also even going to go into the paper trading platform on Thinkorswim for TD Ameritrade. And I'm going to show you how you would actually sell a covered call and what that might look like for you. So if you want to learn all about that, you're in the right place. Let's go ahead and dive right in. So first of all, you need to understand what a covered call is. Well, I put a link in the top of the description of this video to the basics of buying call options and buying put options. So if you don't know what options are, go watch that video. It takes 10 minutes or so. You can figure out exactly what options are, and then you'll be ready to understand what a covered call option is. So the first things first. Well, my dog wants to get out, so of course can't wait. All right, go ahead, buddy. Go. Thanks. All right, sorry about that. First things first. Selling a call option is a bet, if you will, that the stock will not go above your strike price. So if you're covering that call option, you are essentially covering the cost of the option itself with stock you already own. So each call option is 100 shares. So you need to own at least 100 shares of the stock to sell one covered call option. If you don't have the stock and you sell it, you'd be selling what we call a naked call, and your loss would actually be infinite. So I'll show you what that looks like in a second. Now, if you're going to sell 3 covered calls, then you would need to have at least 300 shares. So why would you consider selling a call? Well, first of all, you're going to collect a premium, and I liken it to being almost like a dividend. Your stock is paying you to own it. Second, you're going to lock in profit on your trades. So if you sell a covered call for $100 and it's $100 right now, the stock is, and you sell the 110 call, you locked in $100 in premium profit. Plus, the worst case scenario is it goes at or above 110, and then you gain all that on the sale of the stock, which I'll give you an exact example here in just a second. One of the things I love about it is if you don't have a play to make, you're not sure what you're going to do, it can keep you active in the stock market. So you can look at the shares you own that are over 100. You can take a look at different option strikes. And again, on the paper trading platform, I'll show you exactly what that looks like. And then you can decide, hey, I don't think this stock will be that high. I'm willing to sell this. And worst case scenario, I lose my shares, but I get paid a ton of money to do it because they're going to have to pay me that strike price plus the premium already received. So it's a guaranteed way to make money. Caveats to this, again, I'm not a financial advisor because they would never say that, but basically the caveats are if your stock goes up above your call strike price, the buyer can exercise your stocks if you do nothing about it. So they can take your shares, but they have to pay you the strike price. So again, if we go look at $100 strike price and you sell the 110 and you receive $1 in premium, that's $100 in cash immediately. Worst case scenario goes up to 115. They're actually going to have to pay you the 110 per share. And remind you, right now it's only $100 a share. So if it's a month out and it goes up to 110, you just made $10 per share plus $1 per share in premium. So you just got paid for those shares. You got paid $1,100 more than they're worth today. So you're essentially locking in a profit, worst case scenario. Now, if this is stock you're going to own forever and you always own it and you never sell it, and the stock trades sideways or it goes down, you're going to collect premium you never would have collected, or essentially get the dividend that you would not have gotten. So let's see here. That's pretty much it. I want to dive into the paper trading platform. I hope that you understood that. Before I really dive into this, take a moment. If you have questions, write them in the comments here. And obviously, if you like this video, hit the thumbs up button, and I'd love it if you subscribe for future videos like this, because I love to teach and train, and I've spent a lot of time learning the basics of this stuff, and I'm excited to share it to whoever this could potentially help. So, on the paper trading platform, I have bought 100 shares of DraftKings, and I've also bought 100 shares of the SPY, which is an ETF, an exchange-traded fund that mimics the S&P 500. So, let's just pretend we want to sell DraftKings. Now, one thing I want you to notice about DraftKings, let's take a look at the ticker symbol here real quick. Charts, DKNG. Here's the DraftKings chart. We are on a 20-day chart. So this is the last 180 days. Its high was $65. That was back on October 4th. It's currently trading at 54. It's been kind of bouncing around a little bit. Pretty volatile stock, and it had an update today. It's had an update the last few weeks here, actually. A lot of good news in the DraftKings stock. These are the last 10 days. So why am I showing you this when I'm trying to tell you about covered calls? Well, one of the things I want you to understand is that as the stock is rising, the volatility for the stock is going up. So the cost of the option itself will typically also be going up. So we're looking at DraftKings. Here is your option chain. It goes all the way out to January of 2023, January 2022. These are leaps. And then, of course, you've got a lot of months this year. So let's just look at 1 month out, because right now it's January 13th as I'm filming this video. February 19th is about a month out. I can sell. It's currently trading at $54, so at the money is about $55, this 55 strike. If I thought it was going to go down and had no way of going up any further, obviously I don't think that, because I own this stock and I like it and it's very volatile, so I wouldn't trust that. But if I thought it was going to go down, I could actually sell one of these, which represents my 100 shares. And right now someone's willing to pay $4.60. Now again, that's times $100. So they would actually give me $460 in premium. Now, this is what I want you to note. This is the difference between a covered call and a regular call. See how it says max profit $460? That's because I'm getting $460 today. So the max profit is, it doesn't go above 55 and I keep all the premium. That $460 is the premium. The max loss is actually infinite. And the reason it's infinite is because what if this stock goes to $1 billion? They start trading, allowing gambling in electric vehicle cars that they invent that also cure cancer and let you live forever. And it goes to $1 billion. Well, you literally could lose infinite amount of money, right? That's why you want to sell a covered call from a risk perspective. You want to make sure you're covered. So as long as you have 100 shares, then you should be safe. And no matter what, at 55 strike price, that's the worst case scenario, is they take your money. Now, it says the break-even stock price is $59.60, and the reason it says that is because if it goes up to $59.61, you just lost 1 penny times 100. You lost $1. That's because you're going to get $55 per share for your stock. You're going to get $460 in premium, which is $4.60 per share. So $4.60 plus 55 is $59.60. So that's your break even. So if it goes up to 57, you might lose your shares. Someone else can exercise this contract and take them because there's some value there. But you actually gained the $2.60 above and beyond the 57. So if that doesn't make sense, go watch it again. And then if it still doesn't make sense, write in the comments how I can help clarify that for you better. So that's how you would sell a covered call. Now I want to show you some other things here. If you remember from the basics options video, there's 3 main things: the strike, the premium, and then of course the expiration date. So we went a month out. Well, what happens if we go to, let's say, May? So that's February, March, April, May. That's 4 months from now. That same strike price, I can get double the amount of premium. So I can get $900 today, if I was to sell this one covered call right now, I could get 900 bucks. So DraftKings would have to go above 64 for me to lose money. That's $9 plus $55 is 64. Anything above 64, I'm losing money. Now, I'm not actually losing any of my money. I'm just losing the money I would have made if I would have just held onto the stock by itself. So, for example, if it went up to 65 on May 21st of 2021, I would have lost $1 per share times 100 shares. I would have lost 100 bucks of potential gain. Now, obviously, I just made, because it's currently trading at 55, I just made 64 per share, so I made $9 a share times 100. I just made $900, right? So there's a lot of really neat things for you to consider when it comes to selling covered calls. So just for fun, I'm going to put this in the paper trading account. I'm actually going to go a little further out of the money. I'm going to say, look, I'm willing to take, I don't think it's going to go to 90 by May 1st or May 21st. I don't think it's going to be there. So I'm going to sell this covered call, and I'm going to sell it at the mid for $1.70. So someone's going to pay me 170 bucks for this share. It says 1,700 because I left it at 10. That's one thing. You can actually change this if you want on Thinkorswim. You can change it. There you go. 170 bucks. So not only would the worst case scenario is DraftKings goes to $92. In which case, I'd get $91.70 per share of mine. Not bad, right? So this is kind of why I'm saying it's like guaranteed money. The worst case scenario is it goes above what you thought it would, and you lost the opportunity between what it is and what you thought it would be. So on this one, I actually probably wouldn't go with a volatile stock like that. I probably wouldn't go that far out. I'd probably go into this range and say, look, it's a month from now. The current chart, the all-time high for this stock is 65 bucks. It's currently at 55. We've got potential stimulus coming up, or at least talks about it in the next, by tomorrow, actually. So this stock could skyrocket here in the next few days. I probably wouldn't sell it today, to be honest. But if I had to sell it today, I want to wait and see how the market reacts to this stimulus. But if I had to sell it today, I might just say, you know what, I'm going to go with something safe, and I'm going to sell the 80, and I'm going to collect, let's see, I'm going to collect 35 bucks in premium. And hey, you know what? If it trades at over 80, I'm going to be happy, because in a month from now, I just made 25 bucks a share. What the heck? And again, on this one, I wouldn't get too worried about it. I probably wouldn't even trade it. So anyways, I hope you guys enjoyed this video. Be sure to subscribe, hit the like button, and obviously, if you have questions on how I can better help you with this, I want to go ahead and answer those. So write them in the comments. And then lastly, I guess I just want to let you know, if I was to sell that covered call, and we're in the paper trading account, so I probably should just do it, but it's after hours and it's hard to do it anyways. But if I was to sell that covered call and I was going to lose, so gosh, I can't believe I forgot this. If I was going to lose, if I got to this point and it was all the way at 80, you can actually roll out of this. You could buy it back for whatever the premium is, and then sell a later call on the same strike price, or even lower strike price if you wanted to. And you could collect the difference and give yourself more time. So if the stock had an incredible run a couple days before you were supposed to close it out, you could roll out and roll up. And that's a little bit more advanced feature. I'll actually show you in a later video at another time. So I hope you enjoyed this video. Thank you so much for watching. Have an amazing day, and best of luck to you if you choose to sell covered calls. Again, this is not financial advice. Good luck out there.